Hi, I'm Mark McCarron, and I'm Wescott's Chief Investment Officer, and welcome to the first in a series of Wescott updates. In this podcast, we want to address three questions that clients have been asking recently. One, what's behind this year's strong markets? Two, what has Wescott been doing in portfolios to position for what's next? And three, what is Wescott's outlook for the coming year? So let's address the first question. 2019 has been a very good year in markets, and this has led to very strong returns in client portfolios. U.S. stocks have reached new highs, and bond markets have experienced one of their best years in history. However, we are mindful that we're in the 10th year of an expansion, which has officially become the longest on record at well over 120 months. The natural question many are asking is when will we experience the next recession? And how do I prepare for it? So to answer these questions, I think it's important to put the recent market performance into some context. As good a year as it's been in 2019, it comes off a very difficult 2018, where most asset classes from U.S. stocks, non-U.S. stocks, and most commodities experienced negative returns, particularly during the fourth quarter of last year. While underlying economic conditions in the U.S. have been quite good, concerns were rising in two areas. The first was global manufacturing activity was slowing, and that's really due to the uncertainty surrounding the trade wars. And two, the U.S. Federal Reserve was normalizing their monetary policy, which in other words means they're increasing their rate, and they did that 4 times in 2018. The fact that these two things were occurring simultaneously led many to expect that the global economy would stall and eventually fall into recession. And that's because higher borrowing costs tend to slow economic activity at the margin, and the Federal Reserve's policy rate drives most borrowing rates in the U.S. economy, such as mortgage rates. At the same time, the uncertainty surrounding the terms of trade between the U.S. and China caused activity in housing, autos, and manufacturing to slow down. As a result, companies that are most exposed to an economic slowdown, such as energy, materials, industrials, and consumer cyclicals, they all sold off. In fact, the fear of recession was so great that investors temporarily sought out safe havens such as gold, U.S. Treasuries, and dividend-paying stocks. It was as if the market had decided that if things didn't change, the U.S. and global economies were headed for recession. So what's changed? Well, the two concerns that investors had at the end of last year have been addressed to some degree this year. While the trade war is still with us and will likely continue to dominate headlines, the news flow of late has been more positive. This has taken some pressure off the cyclical sectors of the economy that had sold off previously. It's also important to put the U.S.-China trade war into some context. According to research that we read, published by Bank Credit Analyst, or BCA, U.S. exports to China represent only about 0.5% of U.S. GDP, while Chinese exports into the U.S. account for about 3.4% of Chinese GDP. In other words, direct tariffs on goods traded between each country may be negative at the margin, but may not necessarily drive global growth one way or the other. Second, and most importantly, I think, the Federal Reserve reversed course and has started to cut policy rate rather than rise. This also takes some pressure off of the global economy by lowering borrowing rates again, which encourages growth. In fact, we've seen an improvement in the U.S. housing market now that mortgage rates have fallen again. So against this backdrop, what has Wescott done? Well, over the course of the last 2 years, given where we are in the economic cycle and in anticipation of heightened uncertainty associated with the trade war, Wescott has reduced some exposure to the more economically sensitive positions in client portfolios, including energy, small cap, and commodities. In addition, our allocation to large cap stocks, particularly those with a more defensive profile, have been increased. At the margin, these adjustments have protected portfolios during the periods of market volatility. In addition, Wescott maintained exposure to certain investment strategies that favored high-quality stocks and gold, in fact, gold bullion or bars. During the most difficult periods of market volatility over the past year, it's these defensive exposures that held up quite well. which allowed our clients' portfolios to weather the constantly changing environment. Just as a reminder, prudent diversification across both traditional and alternative asset classes using both a passive and an active approach, and the fact that we're managing risks and controlling costs is the most effective way that Wescott sees to achieve the goals of wealth creation and capital appreciation and preservation. And we seek to achieve this really by investing with and allocating to specialist managers across the world that have unique skill sets and specific styles. At the core of our portfolio is a value discipline that seeks to take advantage of areas of the market that are being overlooked, but offer a premium to those who have the patience to hold for the long term. And that's important because really the third question is, what is Wescott's view for what's coming next? And to that end, we remain committed to the long-term opportunities we see ahead in both the U.S. and non-U.S. markets. While the last 10 years have been very strong for U.S. stocks, and growth stocks in particular, the next 10 years may play out differently. In a scenario where lower interest rates in the U.S. and abroad, combined with a de-escalation of the ongoing trade war, global equities could break out of the trading range they've been in really since early 2018, and bond yields may rise. Within Wescott's bond portfolios remained focused on higher quality bonds with relatively short maturities as a result. In addition, more economically sensitive sectors such as energy and financials that have been impacted by recession fears recently may recover, and this would support our value-based positioning within our equity strategy. And non-U.S. markets are trading at valuations that are much more attractive than that of the U.S., and as a result, offer more attractive return premiums going forward. In fact, European markets tend to be more cyclically exposed and would perform well in this environment, particularly if the U.S. dollar were to weaken from its highs. As we look toward 2020, we recognize that there are risks ahead that could affect this outlook. Political uncertainty and trade uncertainty remain at the forefront of investors' minds and will keep investors on high alert. However, Wescott's portfolio remains balanced and positioned in segments of the market that are offering value and opportunity going forward.